All right, today we're going to unpack a really interesting and, let's be honest, a pretty complex investment strategy. It's called the QSIF Equity Ex-Top 100 Long-Short Fund. Yeah, I know, it's a mouthful, but stick with me because every single part of that name tells us exactly what this fund is trying to do. So let's dive right in.
First up, who's behind this? This whole strategy comes from Quant Mutual Fund, under their QSIF brand. Now, QSIF stands for Cross-Asset, Cross-Market. So right away, you know they're thinking a little differently about how to approach investing.
So let me just throw a question out there for you. What if you could build a portfolio that intentionally ignores the giants, the huge companies we hear about on the news every single day? That's really the core idea we're going to explore here.
To really get a handle on what this fund is all about, the best place to start is, well, its name. We're going to take it apart piece by piece, and it'll all start to make sense.
Okay, first piece of the puzzle, Ex-Top 100. This is actually pretty simple, but it's so important. It just means the fund deliberately invests in companies that are not in that top 100 list of largest companies. We're talking about the world of mid-cap and small-cap stocks, a totally different universe from the big established players. This is where a lot of investors go hunting for those hidden gems with potentially much higher growth.
And next up, long-short. Now, this is where things get really interesting. This is a strategy that's trying to make money from stocks going up and from stocks going down. It goes long on the companies the managers think are winners, and it goes short on the ones they think are losers. It's kind of like playing both offense and defense at the same time.
So, with all this complex maneuvering, this dance of buying and shorting, what's the end game? Well, it all comes down to one primary goal: to generate long-term capital appreciation. The big bet here is that this very active, two-sided approach can deliver solid growth over the long run.
So, how does this actually work in the real world? How do you play both sides of the market? Let's get into the nuts and bolts of the long-short strategy. Think of it like this. Going long is what most of us already do. You buy a stock because you think it's a great company and its price is going to go up. Simple enough. But going short, that's the other side of the coin. Imagine you think a stock is way overpriced and is bound to fall. The fund can actually borrow that stock, sell it immediately at its current high price, and then wait. If they're right and the price drops, they buy it back cheap, return the borrowed shares, and pocket the difference. It's a way to profit from a decline. And this table here really shows you where the money is supposed to go. Just look at that very first line. It says a minimum of 65% of the fund's assets has to be in those Ex-Top 100 stocks. That is its main playground, its core identity. The rest of the allocation gives the manager some wiggle room, to maybe dip into larger companies or hold some cash if they feel cautious.
Now here's a really crucial detail about the shorting part. The fund can take what are called unhedged short positions on up to a quarter of the portfolio. In plain English, that means these aren't just for protecting the portfolio. No, these are active, direct bets that a particular stock's price is going to fall. It's another tool they use to try and generate returns.
So with a strategy this specific and this complex, you can probably guess it's not going to be for everyone, not by a long shot. So let's try to sketch out a profile of the kind of investor this fund is really built for. And as we go through this, really ask yourself, does this sound like me? Does this match up with my own financial goals and my comfort level?
Okay, first things first, and this is a big one. There's a pretty significant barrier to entry. The minimum investment is 10 lakh rupees. That right there tells you that this fund is aimed at more experienced investors who are working with a substantial amount of capital.
So who's the perfect match? Well, it's someone who's definitely in it for long-term growth. It's an investor who actively wants to diversify away from the usual big-name stocks. And, this is absolutely key, you have to have a high tolerance for risk. You also need to be comfortable with the idea of complex strategies involving derivatives. And of course, you've got to have the capital to meet that big minimum.
And speaking of risk, we absolutely have to talk about it. Because with a fund like this, it's a constant balancing act between the potential for big rewards and some very, very real risks.
And you don't have to take my word for it. The fund's own documents make this crystal clear. It is officially rated in the highest risk category there is, level 5. They are not hiding it. This is a high-stakes strategy. And this right here is the biggest reason why. I want to read this quote directly because it is so important. Short positions carry the risk of losing money, and these losses may grow theoretically unlimited. Let that sink in.
When you buy a stock, the most you can possibly lose is what you paid for it, right? It can go to zero. But when you short a stock, if you're wrong and that stock just keeps climbing and climbing, your potential losses have no ceiling. They are, in theory, unlimited.
And beyond that massive risk, there are other things to keep in mind. This fund is likely to have high portfolio turnover, which means more buying and selling, and that can rack up transaction costs. The fund's success also relies heavily on the skill of the managers to pick both winners and losers, and that is never, ever a guarantee. Plus, trading in smaller stocks can sometimes be tricky if not many people are buying or selling, which can make things costly.
So, if you've heard all that and you're still intrigued, if the risk hasn't scared you away, here is a final checklist for you to go through before you even think about making a decision. This is your own due diligence.
First, always check the costs. For this fund, there's a 1% exit fee if you pull your money out within the first 15 days. Second, be fully prepared for that high portfolio turnover we just talked about. And third, and this is probably the most important, do your own homework. Be transparent with yourself. Dig into the fund's actual holdings. All the details are right there on their website. Which brings us to the final, and I think the most crucial question of all. This fund offers a really unique way to diversify your portfolio, to step outside the mainstream market. But that opportunity comes packaged with a whole lot of complexity and a significant amount of risk. So the question you have to ask yourself is this: is that a price you are truly willing to pay?